The Real Estate Investment Trust, or REITs, functions as a legally defined wrapper converting the income streams of physical property into publicly tradable equity instruments. Historically, real estate required significant capital and absorbed high illiquidity, but the 1960 congressional mandate established REITs to allow investors a fractional, institutionally managed claim on net operating income. As of mid-2026, the sector is experiencing a quantitative dislocation. Equity REITs have returned 14.2% year-to-date, significantly outperforming the S&P 500. This shift follows the 2022-2023 Federal Reserve rate cycle, which mechanically repriced income-producing assets by raising implied cap rates. Consequently, institutional allocators, including 75% of major U.S. pension plans, are utilizing REITs as a capital-efficient route to scale real estate exposure without transactional friction. The structural moat for these assets is defined by replacement cost discipline. In sectors like Class A industrial or data centers, the cost of new construction has risen so sharply that existing assets trade below their replication cost. This gap acts as a ceiling on new supply. When a developer cannot achieve a viable return on new construction at prevailing rents, they cease building, causing existing inventory to tighten. Data from Q3 2025 shows average REIT occupancy at 93.0%, with retail reaching 96.9%. While the office sector faces permanent demand destruction, institutional managers are reweighting portfolios toward industrial and Sunbelt multifamily sectors where the supply and demand math remains favorable. This shift is not a trend, but a response to rigid physical constraints and historical occupancy levels. Net operating income, or NOI, is the primary mechanical output of a real estate asset, calculated as gross rental revenue minus operating expenses like taxes, insurance, and maintenance, but before debt service. This figure determines asset value when divided by the capitalization rate. In Q3 2025, REITs reported a 2.8% same-store NOI growth. While modest, this growth is significant because at a stable 7.7% implied cap rate, every dollar of NOI growth compounds into asset value appreciation. A major driver of this growth is the lease mark-to-market. In the industrial sector, many in-place leases are currently 20 to 40% below market rates. As these leases roll over and reset to current prices, the resulting rent spread flows directly to the NOI, increasing the stabilized earning power of the REIT. The capitalization rate, or cap rate, translates this NOI into asset value via the equation asset value equals NOI divided by cap rate. For example, a property with $1 million in NOI at a 5% cap rate is valued at $20 million. However, if the cap rate rises to 7%, the value drops to $14.3 million. Currently, the median REIT implied cap rate sits at 7.7%, creating a 169 basis point spread over the 10-year Treasury yield. In contrast, private real estate appraisals show a spread of only 24 basis points. This suggests a pricing dislocation, where public REITs are systematically undervalued compared to private markets. Historically, such divergences resolve through REIT outperformance, as REITs use their higher-yielding equity to acquire assets accretively from the private sector.
Leverage functions as a mathematical amplifier on equity returns. If a property yields 7.7% and is financed with 60% debt at a 5.5% coupon, the positive leverage spread flows to the equity layer, potentially elevating a 7.7% unlevered yield to an 11% cash-on-cash return. To manage risk, institutional lenders require a debt service coverage ratio, or DSCR, NOI divided by annual debt service, typically above 1.25x. Public REITs maintain conservative profiles, with 88.7% of debt at fixed rates, insulating them from the maturity wall. Between 2025 and 2026, over $1.5 trillion in commercial loans will mature. While private operators face refinance gaps due to rising rates, investment-grade REITs utilize the unsecured bond market to ladder maturities and stabilize their cost of capital. Tax efficiency further enhances these returns through depreciation, a non-cash deduction that reduces taxable income without affecting economic value. Because of this, REITs are evaluated using funds from operations, or FFO, and adjusted FFO, or AFFO, which add back depreciation and subtract maintenance capital expenditures. The 2025 passage of the One Big Beautiful Bill Act, OBBBA, restored 100% bonus depreciation, allowing for accelerated deductions that often classify distributions as tax-deferred returns of capital. Despite the friction of maintenance costs and the 90% distribution mandate, institutional REITs in industrial and infrastructure sectors remain core portfolio anchors. With a combination of 4% dividend yields and FFO growth, a 10% total return trajectory is achievable for disciplined operators who avoid over-leveraged or declining sectors like traditional office space.